Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about velocity banking again, with the emphasis how this video is for Canadians. And to be honest, I've never been to Canada and I know nothing about it, but I was inspired to make this video because YouTube had recommended me this video about why living in Canada has become impossible, right? And it's funny because the thumbnail has like US tagged as rich and then Canada as tagged as poor in much bolder letters. And I'm like, man, people must be struggling over there, right? Like I watched the video and I couldn't like finish it just because like I don't know, I couldn't it's hard for me to watch those types of videos because like because I feel their pain, you know what I mean? And so I decided, you know what, I'm going to make this velocity banking video. It's kind of like financial evangelism, right? It's like cross cultural, cross borders financial evangelism over the internet. And so hopefully someone um, sees this video through the YouTube recommendations or something like that. They're curious. And if you take a look at the channel analytics, Canada is actually number 2 in terms of viewerships. But take a look at this. United States is 86.9% of the total viewership, and then Canada is like 4.5%. So it's like way behind the US, which is I mean, it's crazy how there are so many other countries that can benefit from this, but they're just not aware. And you know what's even crazier? Australia is where supposedly this concept originated from, and they only make up 0.3% of the audience. So it's kind of like how certain concepts like pizza and hamburgers came from other countries. And then in the United States, we just kind of made it our own, kind of like velocity banking. And then now we're the most active in quote evangelizing this concept in I guess the entire world, including the U.S. Right? And I don't know if you knew this or not, but in the United States, yes, a lot of people are struggling. I get that, but I feel like the reason why a lot of people are struggling is because it's like going to Home Depot. You ever been to Home Depot? In the U.S., we have so many Home Depots, right? But you go into the Home Depot and you look inside and there's like thousands of tools. And you know what happens every time I go? I say like, whoa, like there are so many tools out there, and if I just knew how to use them, I could do so much crazy stuff, but I don't. And so I just buy a light bulb and leave, you know? So that's what happens to me. But in other countries like Canada, you don't have as many opportunities. And even people in the US aren't aware about their own opportunities. So, what I mean by that, one of the reasons why velocity banking may not be popular is just because you don't have as much maybe credit products like you would in the US. And what do I mean by that? Well, Canada, I don't know if you knew this or not. I actually remember when I took a class about multifamily, like apartments and stuff, this teacher was like, yeah, you know what the difference between Canada and the US is? Is like, he just like randomly brought it up. He was like, yeah, well, Canada only has like 6 banks, and the US has like more than 4,000. I was like, what? Why didn't anybody teach me this? Nobody taught me this in high school, college, or whatever. And I was just like, yeah, it's like going to Home Depot. I guess like if I guess the tools are there, if somebody just taught me like I'm doing right now in this video, like I think my life would have been a lot easier. And you might be like, are you kidding me? Only 6 banks? Yeah, well, let's just go ahead and ask ChatGPT this, right? And you'll see what I'm talking about. So let me just do this. How many banks in US versus Canada, right? For at least 4,000 banks include community, regional, and national banks. And there's 4,700 credit unions. So in total in the United States, 8,000. And Canada has around 80 banks, like in total. And the big six dominate the market. So you see the word six. So let me actually just play this from ChatGPT, read it out loud.
The banking landscapes of the United States and Canada differ significantly in terms of the number of banks and their structure. United States. The U.S. has 4,000 to 4,500 banks, including community banks, regional banks, and national banks. This figure reflects a highly decentralized banking system with a mix of large institutions like J.P. Morgan Chase and many small local banks. In addition to banks, there are over 4,700 credit unions, further diversifying financial options. Canada. Canada has a much more concentrated banking system with around 80 banks, including domestic, foreign, and Schedule III foreign bank branches with restrictions. The big six banks dominate the market, holding the majority of assets and providing most of the financial services. These include RBC, TD, Scotiabank, BMO, CIBC, and National Bank. Key differences: the U.S. has a much larger number of small, localized banks catering to specific communities or regions. Canada's banking system is highly centralized with a focus on stability and national reach. Would you like details on specific banks or trends?
And this is kind of why I get mad at my fellow Americans when they talk about where do I get a line of credit. Because, like, here's the thing: if you lived in Canada and you went to the big six, like six places, and you get rejected, I'm like, oh, okay, well, you don't have that much options, right? But in the US, like, 4,000 to 4,500. And so when you tell me you went to six places, you're like, okay, like, you didn't look hard enough. You know what I mean? But most people don't really even know their own options. Now, let me ask another question. Is velocity banking more popular in the US or in Canada?
Velocity banking is significantly more popular in the United States than in Canada due to differences in mortgage structures, banking systems, and financial habits. Why velocity banking is more popular in the U.S.: 1. Mortgage flexibility. U.S. mortgages often allow for prepayments without penalties, making it easier to apply the velocity banking strategy to accelerate debt repayment. Many Americans use HELOCs, home equity lines of credit, a key component of velocity banking, to manage cash flow and pay down principal faster. 2. Financial education trends. The U.S. has a thriving financial literacy movement, with seminars, courses, and YouTube channels promoting strategies like velocity banking as alternatives to traditional financial advice. 3. High consumer debt. The U.S. has higher levels of consumer debt, including credit card and student loan debt, making strategies like velocity banking appealing for debt reduction. Challenges in Canada. 1. Mortgage penalties. Canadian mortgages often come with prepayment penalties or restrictions, which can reduce the effectiveness of velocity banking. Fixed rate mortgages in Canada are more common and less flexible, limiting the application of this strategy. 2. Banking system. Canada's concentrated banking system offers fewer HELOC options and generally promotes more conservative debt management practices. 3. Lower awareness. Financial strategies like velocity banking are less widely discussed in Canada. Canadians tend to focus more on traditional methods like lump sum payments or biweekly mortgage payments to accelerate payoff. Would you like advice on adapting velocity banking for the Canadian market or details on teaching it in the US?
That's interesting. I'm gonna have to go further deep into that. Now, it doesn't mean you can't do it in Canada because even the big six, like RBC, Royal Bank of Canada, offers a line of credit. So you see right here, RBC, that stands for Royal Bank of Canada, they offer a line of credit. It's called a Royal Credit Line, so it's like your royalty. That's awesome, right? And again, one of the reasons why probably why Canada and most countries is hard to live is just people just get into credit card debt. In fact, let me look up Canada credit card debt, and says right here, young Canadians show struggle with credit card debt. Right, so a lot of people. I mean, it's kind of similar to the U.S. It's not. I think the U.S. is kind of like the country that kind of creates all this dysfunction, kind of like fast food. But we always have a movement that goes against it, in a way. Like kind of like how there's the U.S. started McDonald's, but then the U.S. also started Whole Foods, right? And you just have to make a choice, at least in the U.S., where you're going to go, McDonald's or Whole Foods. But in other countries, you don't have as much options, and sometimes just the dysfunction is there, but the solution is not, right? Okay, so let's go into velocity banking. What is velocity banking? All it is a debt payoff strategy that you can use. And again, you can do it as long as you have access to a line of credit. Okay, And you can see here in Canada, you can get a line of credit. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. Okay, so I know that Canada offers credit cards because we just saw a YouTube video about Canadian credit card debt, right? So that is a line of credit. Now, the numbers might be different, right? So you may have a mortgage that's way more expensive than you would have in the U.S. But in the U.S., in different parts of the area of the world, I'm sorry, of the country, you have mortgages that differ as well. So a Canadian mortgage, and let's say in maybe like Vancouver or one of those other big cities, probably will be similar to Los Angeles or San Francisco. Because I remember that in Canada, a home price is like more than $1 million. I think in like Vancouver, it's insane. But that's the same thing in like New York and Los Angeles and San Francisco. So different markets, I'm sorry, different countries with similar landscapes have the same prices. Okay. So first thing you need to do for velocity banking is number one is you need a budget. Okay. So instead of average American, I'm just going to put average Canadian for this video. You're special. Like I actually got a comment a long time ago where it's like, why do you put average American? Like, other people besides American are in this situation as well. It's like, all right, if you want to be labeled as like struggling with money, I guess I could just put average person, but I like to put the average American. But what do we mean by average American, Canadian, or whatever? It's what's your main operating account. For the average Canadian, the main operating account is their checking account. Now, for someone who's doing velocity banking, it would actually be their line of credit. Okay. And so all we need is we're going to do a budget, very simple income, expenses, leftover savings. And then in our expense breakdown, we list every single debt that we have and the payment, and also our expenses that are non-negotiable that we always have to pay for, like food, gas, insurance. We always got to pay for that, right? Now, again, your market and where you live and all that, all the costs will be different. So I'm just kind of making this up and basing it on US figures because I don't know prices in Canada. Although sometimes I go into the Nintendo online store and it actually sometimes brings me to the Canadian store. It's like, wow, that's $10 more, but it's 10 Canadian dollars more than the US prices. So I don't know if there's an actual difference or not. But we're just going to assume US prices just because that's all I know how to work with. And price is all relative. We all know that, right? So let's go ahead and copy and paste this section into velocity banking. But here's what we're going to emphasize. Number one is that we have this exact same income, right? So we're not going to make more income, or it's going to be exactly the same, but the savings is actually going to go to zero. So this is a huge shocker for most people that their savings would go to zero, whether you're in the US or Canada, because a lot of banks teach you to have savings accounts, right? It's culturally ingrained for people to have savings and feel good that you have a savings account. But when we're doing velocity banking, we ain't gonna have a savings account. In fact, where's my yeah, it's a copy of my checking account. Money comes in, money goes out, and then it goes to zero. I have nothing in my checking account. Absolutely nothing. So in velocity banking, that's kind of one of the key components that we have to make sure that happens in our budget in this velocity banking column and not in the average Canadian column. In fact, let's just do this. Can I make this red? And then we're going to make the font white, right? Maybe do the Canadian little theme here, right? Okay, so let's just assume we have access to a line of credit. Now, I don't know what typical interest rates are in Canada. I'm just using the again, American, what I know of America, what the market is like there. But let me just take a look here. Student line of credit. Ooh. Flexible, low cost way in interest rates are typically lower than those offered by credit cards. And you got a secured line of credit available from $5,000. So $5,000 seems to be the minimum limit, right? So that's pretty good. So maybe we might be able to get a huge line of credit. All right, so let me just go here. All right, so let's just assume we have an $80,000 line of credit. And again, that's going to depend on your situation. Now, here's the thing that I know is true of a bank in either the United States or Canada. Banks don't lend money to people who need it. They don't lend money to people who need it, right? And so if you're in a struggling situation where it's like, well, I wouldn't say struggling, but if you don't have that much left over, like you're making 6,000, you have expense in the 5,000 range, and you only have $1,000 left over, I don't think a bank will lend you a line of credit because again, they're a risk management institution, and so they always like to lend to low risk borrowers. So the most important thing is if we're getting a line of credit like here, what we see in Canada, we need to get it way before we ever need it, right? Because, if we try to get it before we need it, now, I don't know what credit bureaus they're using, or if they're using the big three like we do in the US, but um, it's going to be hard to get it if you need it because, like I said, it's a risk management institution. A bank is just like an insurance company is a risk management institution, although they play the game a little bit differently. Okay, but all right, so let's go ahead and do this. And so we see $80,000 limit, month zero. So it's like kind of have an $80,000 credit card, and this is my actual line of credit. Believe it or not, is 280,000. And I have over $527,000 in lines of credit. 527,000. Probably within a few years, it'll probably be a million. I have way more than I need, and that's why the bank lends me the money because I don't need the money, right? Like that's see how that game works. So, all right. So now, once we've done the set this part up, as an average Canadian, I'm not going to do something called segregate my income. What does that mean? Is I get paid and then I use my checking account to pay these bills. So this is four places, right? So four debts. So your money gets split into four places, and then you have your little bit left over in savings. So what we're going to do is we're going to move some of this debt into our line of credit and make it as our main operating account. So let's go ahead and do that. So let's see how much credit card debt we have. So that would be $42,000 of debt, right? So $42,000 of credit card debt. So let's go ahead and move that here. 42000. Okay. And what happens when we move the $42,000 of debt? Guess what? This goes to zero. And now, without doing anything, our cash flow went from about almost 1,000 to $2,339, right? So $2,339. And now what we're going to do is we're going to put our entire $6,000 into the line of credit as essentially an overpayment. And then we take the expenses out. And then after every single month, we're going to lower the balance by the entire amount. I'm sorry, this cash flow, this entire cash flow amount. And we just rinse and repeat over and over again. See how easy that is? You can do it here and you can do it in Canada. Okay, so you could do it in the United States or you could do it in Canada. And okay, in order to calculate the next month's balance, it's based on the previous month's balance and the previous month's interest minus our cash flow, so 239.16. And then we got to calculate the interest. The interest is going to be based on the average daily balance, right? Average daily balance, and then multiply it by the interest rate, and then you divide by 12. Okay, and then we're going to go ahead and copy and paste, and then copy and paste, right? And then we see that in 20 months, okay, we were able to pay this thing off, right? It was really easy. Don't even have to try, and we're good. Okay, so let's just go ahead and do that. All right, that's cool, man. All right, so now in 20 months, right? So 20 months, we paid off 42K of credit card debt. Wow, that was so easy. That was so easy, right? And so now the next thing we got to do is pay off this auto loan. So now in we have this loan calculator right here where all we got to do is just type in the current month and then it tells us the auto loan, right? Like what's the current balance of the loans that we have. And so we see right here it's 14 grand. And so because this is the lowest balance, right? And it gives us a significant amount of payment for paying it off, we can just move this into that line of credit. So now let's go ahead and move this this auto loan into the line of credit right here. So control paste right here. And so now it's, whoopsie, plus 14092.12, right? And now after we've, actually, what happened to the font? The font should be yellow, right? Whoopsie. What am I doing? All right, so let me make the font, I'm not yellow, red. Okay, so now after moving this auto loan into the line of credit, guess what happens to our cash flow? It increases by $396. Okay, and then now our cash flow is 2,700. Whoa, that's pretty good cash flow, right? So now what we're gonna do is just gonna paste this right here, and then now it's gonna be 2735.19. I think it rounds up, right? 19. All right, cool. So now we got that covered. All right, 25. All right, so now 25 months. So just 5 more months it took us to pay off that auto. Holy balls. All right, I don't know if they say that in Canada, but I say it here in the US. Okay, so now here, all we gotta do is pay off the mortgage. Now, I know that many Canadian places, the mortgage is just like living in California, right? Like it used to be affordable, but now it's like impossible to live. So, but hopefully, and I don't know about how the Canadian housing market is like, but there might be some affordable places. At least in the U.S., you got the Midwest and the South, right? But in Canada, I don't know. But hopefully, you know, if you're able to afford $1 million mortgage, you probably got the income. Hopefully, right? But let's just assume you have a $300,000 mortgage. Now, with a $300,000 mortgage, do we want to put the whole thing in a line of credit? Probably not. Number one, the interest rate is much higher. But even if with the high interest rate difference, if you just put pieces of the loan into the line of credit, you could still do the strategy, right? But you don't want to put the whole thing in, okay? And the other thing too is we don't even have a big enough limit to put the whole thing in a line of credit. And I definitely don't see the value of replacing your mortgage with the first lien home equity line of credit. I see it all the time on the internet, and I'm like, no, you don't do that in the U.S. You don't do that in Canada. You don't do that anywhere, right? You don't need to do that. All you gotta do is just put a piece of the mortgage into the line of credit, and then just pay it off quickly with your cash flow, and just do it over and over again. So let me just go in here and see in 25 months what the current balance of this loan is. So if I just do this, so G3, okay. So let me just do B3 minus G3, B3 minus G3. So it's 13 grand we paid off in about 25 months. Now let me ask you this: how long would it take us to pay off 13 grand using this strategy? So if I just go here, okay, and I just literally add 13 grand, we'll say 13,200, round it up. How long is it going to take to pay that off? 1, 2, 3, 4. Whoopsie, did I screw up? I think I screwed up. Okay, so how long would it take? 1, 2, 3, 4, about 5 months to do what took us 25 months, right? So that's basically the basis of the strategy of using your line of credit, and you just rinse and repeat over and over again. So I'm not going to go too much into it. I probably need to make a video to go more into detail, but to be honest, like this is probably the least important part. You know, people get too obsessed about like extra payments versus like chunking. The reason I'm going to do chunking or just taking a piece of the loan into line of credit is because I don't want to segregate my income, and if I do extra payments directly, it really makes it harder to manage my cash flow, which is why a lot of people, when they get a letter from the bank to refinance, that's why they actually refinance, right? A ton of people are like, well, you could just make extra payments. All right, if everybody did that, which is your default option, everyone would have their mortgage paid off in like 7 to 10 years, right? But nobody does that. Okay, so now let's go ahead and open up this Velocity banking calculator. Give me one moment. Okay, hello everybody. So now we have our Velocity banking calculator open here, and I just pre-filled everything out. I was just like, I actually put the video on pause, and then I just pre-filled it out, and you can see right here it takes us about 6.7 years to pay off our 30-year mortgage. Okay, so now you take a look here. We say 31 grand in interest, and a lot of people are like, well, if you chunk more, does that mean that it pays off faster? And the answer to that question is no. So if I do $9,000 chunks instead of 6,000, it's $100 something dollar increase, right? So it's not going to make that big of a difference. And usually the lower the chunk, the more optimal, like in terms of interest savings it is. Okay, so you don't have to do a big amount, just do something similar to your paycheck. Okay, but you can see like it really makes no big difference. But what really makes a big difference, and this is what I'm going to warn you about, is replacing your loan with the first lien HELOC with the higher interest rate. Take a look at that. 8.3 years and 29 grand of interest saved. Whoosh, right? All right. So 6.7 years. This is brought to you by Renatus. I don't know if you knew this or not, but Renatus actually is an educational company, and they sell to Canadians as well. So if you're a Canadian, I can sell to you. Just have a credit card that works in the U.S. And unfortunately, I've actually had people from Canada reach out to me and say, "Hey, they want to buy," and then their credit card got denied. And you want to know something? With real estate investing, finding the money is like 80% of the work. So if you like get denied on your credit card and you just give up, it's like, well, what makes you think that you're gonna be good at real estate investing? Because 80% of the work is finding the money. So if one bank denies you, find alternative methods, right? So I'm not saying like to kind of like make fun or anything. I'm just saying like, this is why a lot of wholesalers get into trouble because, and if you don't know, let me just kind of look up Oklahoma predatory wholesaling law, because so many people got into wholesaling because there's no money and no credit. And what happens is that people get into contracts without money, not intending to ever use it, rather than like, hey, this is a strategy where it's possible for me to not use money or credit, but if I have to buy the deal with money, then I'll go ahead and do it, right? Too many people don't have that mentality, and that's why when people complain to state governments, that's when they start to engage in rules and licensing and regulations, right? So don't just give up if you want something and say, hey, I got denied, and act like that's the end of the world, because if that's your mindset, then it's going to be true, and bad things will happen if you don't pay people, right? So getting the money is 80% of the work. Now, let me go back here, and I'm just going to go here. So we'll just end for this today for my fellow Canadians. I don't know if that's how the people speak in America, but we definitely do say my fellow Americans. Okay, so how long did it take me? 6.7 years. 6.7 years. All right, so 6.7, 6.7. Actually, let me do this. 25 divided 12 plus 6.7. All right, 8.78 years, debt free. No more mortgage. We're good. Okay, we're good. Okay, so how much debt was that? That was uh, total of 362K debt. That's all of it. Okay. All right. So 8.78 years debt free, and then we take a look at this. Uh, Listen, if you're from Canada, it's just like in America. People segregate their income, right? But when you're in the velocity banking mode, man, take a look at all of this cash flow. $4,000 of cash flow a month. Okay. So all right. Yeah. Yep, that's it for today then, I guess. So just some financial evangelism, cross-border, cross-cultural for Canadians. And, you might say, well, cross-cultural, how does that work? Just because different cultures, different values, right? In the U.S., we got a thriving financial literacy movement with seminars, courses, and YouTube channels like this one promoting strategies like velocity banking. Okay, now Canadians, again, they're interested, but they need a little boost. They need a little boost, and they need people there to kind of figure out what their options are because, yes, it's much harder, and we have a lot more options here, but it's still possible. Okay. All right. Well, that's it for today. So have a great day, my fellow Canadians and Americans and global citizens and YouTubers. And this is Korean Atlanta Mentorship. Have a great day.